Welcome to the very first step in your trading journey. And if you're new, this is perfect. You don't need to have any experience, you don't need any fancy tools, and you don't need any bad habits that I need to break. And you definitely do not need to be a genius. Trust me, I am not one. What do you need on this journey? A willingness to repeat a process over and over and over that's going to benefit you over a long period of time. Because repetition in anything in life builds confidence and builds on the skills that you need to have and that you will have to make you a profitable trader or successful at anything in your life. Every time you rewatch this video, it's going to make more and more sense. This is not a watch it one time and start trading. You need to be able to repeat this over and over. This is how myself and all of my traders have learned, by going over things and getting the reps in. So take your time with this. Pause the video when you need to, rewind it when you need to, rewatch it when you need to. This is going to be your foundation. And when it clicks, trust me, it will click. You are going to be off to the races. Now, before we get rolling here, I just want to let you guys know, I'm not going to give you trades that you can just copy and buy and move on and just copy me and I'm going to make you rich. No, that's not the idea here. The idea is that you copy me, but you copy my process. I want you to be able to do this on your own. If you can do this on your own, you're going to have a skill that you can use for the rest of your life. So why should you trade? Well, everybody has their own reasons. Some people want to make extra income on the side. Some people are bored and want something new to do. Some people want to make this a full-time career. And that is the great thing about trading. You can make it anything that you want it to be. Now, who is trading for? Well, I often get asked the question, how much money do I need to start trading? And my answer is always zero. And of course, that is not the answer that everybody wants to hear. But I say that because, again, I'm teaching a process that you can use for forever, really. Think about it this way. You're 35 years old. You haven't made a trade in 35 years, right? Well, what's another 2 to 3 months of learning how to trade with $0, saving money, what have you? I would rather you have no money, start paper trading, and figure out exactly what you're going to do so you don't go and blow your account up, versus come in here with $100,000 and just put $100,000 into the market. That is never going to end well. And people will often say, oh, trading doesn't work. Well, trading does work, but it doesn't work when you're just throwing a bunch of stuff at the wall, seeing what sticks. And that's exactly what that is. So who is it for? It's literally for anybody. You could be of any age. You could be of any type of economical situation. It's a skill that you're going to use for many, many years to come. That's why it can be for anybody. Now, with that being said, trading doesn't just come down to the charts that I'm going to show you. It comes down to right here. It's a very, very psychologically challenging arena to be in. You see, first of all, there's money involved. So anything that there's money involved with, you're going to have some type of larger emotional attachment. The second thing is there is so much news and there are so many voices surrounding. It could be from people on pundits on television to people that you're seeing in chat rooms to what you're seeing on Yahoo Finance. It can be a very, very tough arena to be in. So you need to become mentally strong. You have to be able to say, this is the process. I am sticking to it. I am not going to chase hype out there just because my friends are talking about it. I am going to stick to my stocks. I'm not going to chase price. I am not going to chase patterns that I should not be chasing. It can be very, very difficult. And when money is involved, I recommend paper trading to start, taking fake money, and there's different programs out there. You can go and trade. I promise you, you put $1 in the market, and let's say you lose 5%. It's 5 cents, right? It's not a big deal. That is going to feel very, very different than if you're trading with no money or fake money. When money is involved, it can be gut-wrenching, and you need to be able to adapt to that and be able to psychologically maintain yourself and your wherewithal as you're trading, especially over a long period of time. I've seen a lot of traders that have had a lot of promise that cannot get over themselves or get over chasing hype, and they never made it. Why? Because they didn't have it here. They got very, very emotional, and it just doesn't work out when you get emotional with things. So there are different types of trades. One specifically that I'm focusing on in this video, and it's called swing trading. So let's cover the other two types of trades. So you have day trading. This is probably something that you commonly hear out there in the media, day trading. So a day trade is a trade that you get into that day, somewhere between 9:30 a.m. Eastern time and 4 p.m. Eastern time, and you exit the same day. So you're looking at candlesticks that are within that one day. You do not stay in something after the market. You don't let it run into the next day. A day trade is just that. It's a trade that is made in the same day. Then you have long-term trading. Long-term trading is something that you can be in for 2 weeks to 2 years in many cases. Not many cases anymore, but in the past, you could stay in a trade for 2 years. Now you're probably looking somewhere between 2 and 8 to 9 months as the longest trade that you're going to make. But these are for people that really don't want to have a ton of involvement. You check your chart once a day, you make sure that your trend is okay, you move on. That's really what it comes down to. Now, we're going to focus on swing trading. Swing trading is very interesting because you can make swing trades within a long-term trade. And I'll show you the comparison on the charts of what I'm talking about when I say that. But swing trading, I like to say it's anywhere between 1 and 5 days. Now, can you have a trade that goes 10, 15 days? Of course you can. But a general rule of thumb, you're going to be in that trade between 1 and 5 days. You're just catching the trend that's happening, say, during the week, and you're executing a trade, you're making a profit on it, you're moving on. It can be a very, very lucrative space. It's a little bit more involved than long-term trading, where you check your chart once a day. And it's significantly less involved than day trading, where you have to sit in front of your screen and do not move. Now, with that, what are some of the pros and cons to swing trading? Well, this is kind of my trajectory that I see as from traders. They come in, they're very excited, they're very eager, they want to day trade. Everybody wants to day trade to start out because they have the dreams of driving the Lamborghinis and living in the mansions from day trading. It can be a very, very daunting task. You have to sit at your computer all of the time. Trust me, I was a day trader exclusively for 2 years. It was a very, very daunting task. All I did was sit on my computer and trade. Was I profitable? Yeah, I was extremely profitable, but it can be very mentally taxing. So once somebody gets into day trading, they go, okay, well, I'm going to try swing trading. And swing trading, they realize, yeah, it's way less involved. It's easier in many cases, but I still want to do less. And they go over to long-term trading and they say, oh, I could just check my chart once a day. That's great. Now, the majority of traders that I see come back and they always hybrid long-term trading and swing trading. There can be a lot of money to be made in swing trading. It's the place where you can go and you can sit comfortably. You can check your chart multiple times a day. It's not a burning sensation that you have to sit on your computer and watch the price move up every penny every hour of the day, just like with day trading. It's a very nice hybrid. This is perfect for the person that is maybe working from home or somebody that is in the office and has the option to have charts on their phone or charts on their laptop or what have you. It's a nice thing to be able to go in, check your charts 3-4 times a day, see what's happening to the price during the day, and that's the type of person that it's for. Now, the best platforms. So when I'm thinking about platforms, there's many out there. There's a lot of private platforms that are out there. There's public platforms that are out there, which are from like your Charles Schwab. They offer Thinkorswim now because they acquired TD Ameritrade. Webull has charts. I'm sure Robinhood. There's so many different charts that you can use out there. I like to use TradingView. TradingView, to me, it's a nice program. It's free for everybody. Now, are there upgrades? Yes. Do I have upgrades? Yes. Do you need upgrades right when you start? No, you don't. You don't need your upgrades until you start trading real money. And that doesn't need to happen for several months. You can get by learning with having the free version of TradingView, and that's why I like it. I also like it because it's extremely customizable. You can really customize anything you want. If you're somebody that likes uploading your own indicators and writing your own code, you can do that. You can absolutely do that. If you just look right here and it says Veda and Kush N1R, these are people that have written their own code. They're what I'm using. So it's a very customizable program, and I know that you can link several brokerage accounts to it if you want to. I personally don't. I do my trading through another brokerage. All I do is utilize these as charts. But the other reason I like these, they have an iPhone app, probably have an Android app. I like that I can go in and look at exactly what I'm looking at right now on the phone. I can be anywhere that I need to be, and I still have access to my charts. And it's not I'm sure many of you have seen, if you try to do something on the computer versus a phone app, it's a disaster. This one is not a disaster. It's very easy to follow, loads all of your charts up to it. That's why I like using TradingView. I don't get anything from TradingView. I just like using TradingView, especially when I am telling the masses about it. Now, you may be looking at this saying, well, how do I make my charts look exactly like yours? Well, we have a video right here that goes into the chart setup. You can exactly replicate my charts on TradingView. It's very, very simple. Go check it out after you watch this video. Now let's talk about something in my process. I always have checklists. You want to be very systematic about this. And this is the checklist that I go through. This doesn't mean that it's everything that you want to have on your checklist. This is just what I like to use. Trading after 10:06 in the morning. Why 10:06? It's such a random time, right? Well, it's after all of the market news and all of the overnight trades, all the options trade, everything kind of settles down at that point. The bid-ask difference, we'll get into that later in the video, but it gives you an idea of how the stock is being manipulated. You could just see there's these different things on here that you need to have. And I have this, I don't have it printed out, but I have it on my iPad. I'm always going through it saying, okay, I need to check this before I execute a trade. Trust me, there's many times that you'll go through here and you'll forget, oh, I forgot that earnings is happening tomorrow. I should not have entered that trade. Am I getting consistent volume? You need to make sure of that. Am I buying right on top of a 200-day moving average? That's not a good thing. It's never a good thing. So there's these little things that you can forget, especially if you've been doing this for a long period of time. You can forget. So it's always nice to have a checklist there. Why not have a backup system? So let's talk about what we look for on a chart. So I have a chart right here, and you'll notice that there's two different charts, and they kind of look a little bit different than each other. This right here on the right side, this is a swing trading chart or a daily chart. This is a long-term chart or a weekly chart. Why are they different? Let's explain it real quick. If you look down here, these are exactly the same. Every one of these candles, this is today, this was Friday, this is Thursday. Every one of them is one day. These are exactly the same thing. Same exact charts. They're mirror images of each other when it comes to these candles. Now, what's different? Well, this obviously has a little bit more detail. It has your moving averages on it, which we'll get into. But most importantly, this down here, these squiggly lines, these are your trends. The trends are your friend. If you can follow a trend, you're going to do very well in this. And I'll get into that a little bit later, but you can see how wobbly this is. Versus over here, I'm saying, okay, well, the candles are exactly the same. Why is this not as crazy as over here? It goes back to what we talked about and why swing trading is a nice way to go. This trend is tracking daily. So every day, it's giving you a kind of a microscopic view of what's happening overall. This is tracking weekly, what's happening week to week. That's why you can stay in a weekly trade a lot longer, months versus days. So if we talk about what is in the trend area, that's this box down here, these red horizontal lines, 32% and 80%, those are the in between here is your sweet spot. The sweet spot is very, very important. This is where you have the highest probability to make money. And that takes me to a point that I should make. You are not going to win on 100% of your trades. It's not possible. It's absolutely impossible. The only person that could do that is Bernie Madoff, and you see how that ended. You cannot win on 100% of your trades. You have to accept with trading, you are going to lose. You're probably going to lose 30 to 40% of the time. Now, those losses, you are going to learn to mitigate. You're going to take small losses compared to your big wins. That's how you stay in this game for a long period of time. But you need to accept that you're going to lose. And we give ourselves the highest probability to win if we are buying stocks where the trend is in the sweet spot. That's where you have the highest probability to make money. So here, this probably lasted for 3, 4, 5, maybe 7 days right here. And then you started rolling over and turning into a downtrend. You're exiting the stock. Over here, however, you're looking and saying, this was in May or April, really. This was May here. Mid-April that you entered this stock. You weren't exiting until somewhere around late August, September. So you can see the difference between the two trends. Now, in this time frame, it's important to note that you could have gone long and short many, 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 many times in here because of the daily. So now that we see the difference between the two charts, we're just going to focus on the daily chart. This is your swing trading chart. Now, let's point out a few things here. We talked about these colorful lines. This is the 200-day moving average. It's the average price over the last 200 days. 100-day moving average price over the last 100 days. 50-day moving average, and the purple line is the 25-day moving average. They're important guidelines to have up there because it shows you different levels of support and resistance. Down here, you have your volume. How many shares are traded per day? If it's red, that means that there was more selling volume than buying volume that day. If it's green, it means that there was more buying volume than selling volume. This average line, this yellow line right here, is the average volume of the stock over the last 30 trading days. So all of these things just give you a little bit more information, and that's it. That's what I have here. I don't have any other indicators. You can go down a rabbit hole of indicators. That's not for me. I have been trading this way for 20 plus years, and this is all I need. Keep it simple, stupid. That is what I go by. Keep it simple, stupid. You do not need to have fancy indicators. Can the fancy indicators help? Yes. Do I think they can significantly create outperformance over what I'm doing right now? No, I do not. That's why I don't use them. I've tried them all. Never really saw a benefit of making things more complicated. So if we're looking at this, we have our trend, our volume, our moving averages, and our candles. That's it. So let's work our way down here. Let's talk about candlesticks. Candlesticks are important because you need to understand what they mean, what a buy signal is. So if you're looking at different candles, you see that we have candles that kind of look like this. We have candles that kind of look like this, maybe thicker on top, wick on the bottom. You can see all these different candles. You have candles that look like this. What do all these mean? And you know what, finally I'm going to draw a candle that looks like this. Actually, I'll draw a couple more. Some that look like that, and some that look like that. So these candles right here, these are basically called doji candles, and that's this candle right here. What's a doji? Stock price opens right here, moves up, moves down. Not a lot of movement throughout the day. It is what it is. You never really trade on a doji candle. It just means there's not a lot of movement happening, right? Now, you also have candles that kind of run up like so, and they pull back. These are really nice candles. They're good candles to watch. Depending on what the volume is doing, we always want to correlate candle to volume and say, all right, what's the volume doing? Are we getting good volume on these candles that are thicker bodied? Yeah, we were right here. So these would probably be nice entry point candles. Conversely, if you're looking at a candle like this, the stock price started here, it moved down, it moved up, and it kind of closed exactly where it was. But let's correlate it to the volume. We had this volume bar. It was less than the average volume over the last 30 days. That's probably why you got this back and forth volume happening, right? Now you have other candles that are like these hammers. So this looks like a hammer. And that is this candle right here. What do hammers typically indicate? A change in direction. And you could see here, after you had a hammer formation, what happened? It ran back up. There you go. That's where, this is where you can kind of start using these little breadcrumbs to understand what's going to happen to the stock price. It's not a crystal ball. It's not going to predict what it's going to do. But if you look at the probabilities of what's going to happen after you have a candle like this, odds are it's going to change direction. You have inverse hammers also that look like this. They're just going the other way, and you typically will get a change in direction to the opposite direction there. Now, the most important candle is an engulfing candlestick. A candle like this that is larger, full-bodied, meaning that it's thicker, and it takes out the high price of the previous day. Right here, engulfing candlestick, thick body, taking out the high price of the previous day, taking out the previous day, taking out the previous day. Versus something like this. This is not an engulfing candlestick. This is not an engulfing candlestick right here. It has a full body, but is it taking out the high of the previous day? Not really. You want to be taking out the high of the previous day like so, like so. Now, I would implore you to go through different charts. Just come over here and put in 200 stocks and start going through them and looking for engulfing candlesticks. And then start looking for hammer formations that change in direction. So you just get used to seeing what's going on. That's the idea here. The repetition that I talked about right when we started the video. Start going through and getting those reps in. The best way of doing it is pulling up 500 stocks here, take the entire S&P 500 and start going through. It doesn't matter what the stock is. Just go through and look at those patterns. Now let's talk about volume for a second here. Volume, we touched on that it was red and green and you had the average volume line. But what is volume? It's the number of shares that are traded in the day. Why do you want to have more volume than less volume? Because that means that people are on your side. Think about if you're pushing a boulder up a hill. You want to have more people pushing that boulder or giving that big weight momentum than less people. Is it easier with one person or 100 people? Of course, it's 100 people. That's the same thing with volume. It's easier for a stock to push to the next level with people buying and pushing. Look at this one right here. This is a perfect example. You get selling volume right here. You had pretty good buying volume coming in. And then how did you get to a higher price? You had even more volume the next day. Then look what happened. The volume sputtered out, and look what the stock price did. It completely sputtered out. It has not gotten up here with a good full body candle since. That's because the volume is not on their side anymore. Mostly because you're at pretty much some type of high over here. I think it's an all-time high with Palantir. With that being said, the only way for you to break through this high right here and stay up here, stocks can always break through highs. Can they stay there? That's the question. The only way you're going to stay up here if you want to take out this level is if you have significant volume for multiple days in a row, 6, 7, 8 days in a row. Okay, now let's start talking about some patterns here. Patterns that we look at when we want to buy a stock. So we know that we want to buy a stock with good volume, right? We know that we want to buy a stock that's in the sweet spot, moving up, having the positive trend, right? We know we want to buy stocks that are not close to these moving averages because they play a role in support and resistance, meaning if you're buying a stock that's going into the 25-day moving average, it's going to struggle to get above. They play like magnets. So look, you moved up here, you got to the 25, you got through the 25, and then look what happened. It sucked it right back down to the 25. Yes, it eventually got through, but you have to look in this time frame right here because this is your swing trade right here. And you got sucked back down here, right? It's very, very tough to break through moving averages. You can see that this for like 12 days in a row was just attached to the 100 or the 50-day moving average. It's a magnet. That's how it works. So let's talk about different formations. So if we pull up a line chart, what formations are we looking for? We're looking for W's. This right here, stock price moves up and it pulls back, and it moves up and it pulls back, and it moves up. And what did you notice about what I drew in here? Well, this low, this pullback low, we draw a line there, is higher than this pullback low. See that? What are these creating? Higher lows. These give you momentum. These give you support. So if the price moves up and it pulls back and it moves up again, the odds are that this pullback here is not going to go below this line right here. Why? Because it created a support level. So when we're looking at buying stocks to go long, we always want to say, I want to buy on W formation. So there's different types of Ws. You have these types of Ws where you have these higher lows. You have Ws that look like this, which are really not going anywhere. And then, of course, you have Ws that look like that, and you really don't want to buy something like that because this level of support was not made, and it's breaking down. This is the type of W that you want to buy on. Conversely, when you're going short, it's M formations. You want lower highs. You want this low to be this low to be lower than this one. Why? Because it's the same thing going in the opposite direction. We'll get into that in another video. But this is what you're looking for, these W formations. So you should always want to pull up a line chart and see what's going on. Look, if you didn't really have any Ws, this is a great example here. Look at these W formations that were formed, and look at this run that you went on. Higher low, higher than there. This one was higher than there. This one was higher than there. Versus over here, we didn't really make any Ws, and what happened? We just went sideways for a long period of time. Look right here. You don't have those higher lows. You're kind of stuck right here. Here, you're kind of stuck right here. So higher lows are very important. It's always nice to pull up a line chart to look at that. Now, before I get in any deeper into patterns, I think that a lot of you would be asking, okay, let's go back to basics. How do we pick stocks to trade? That's cool if you show me all of this stuff, but how do you pick stocks to trade? Like, you have Palantir on your screen. Why did you pick Palantir? Why, if you look over here on this side, why do you have Lulu here, Zim? What is ROK? What is STX? Why do you have these random ticker symbols here? That's a great question. It is an important question that I should answer now. There's a couple of ways of doing this. Number one is coming over here to Yahoo Finance, and you go to most actives. And this is going to go back to volume. I would say write down these 25 stocks on the most actives. What does that mean? They're the stocks that are getting the most volume right now. So you have NVIDIA, Intel, Open, Snap, etc. Write these 25 down. Come back tomorrow, do the same thing. Do this for 5 to 10 days and see which stocks are consistently in there. And then take the top 10 that are in there and pick from those. Pick 5 to 7 stocks that you're going to trade on a consistent basis. That's how you pick stocks. You want to have stocks that have good volume. I often get asked, hey, Mo, I continuously lose money. It doesn't make any sense. Why do I keep losing money? I go, what stocks are you trading? They go, I'm trading Coca-Cola and AT&T. Those don't move. They don't move. They're not active. There's not a lot of volume on them. You're not going to make money. That's just how it goes. You need to have volume on a consistent basis to make money. Getting volume on AT&T from earnings day 4 times a year is not volume. You need to have consistent volume. That's why I like going in there 10 days in a row, because you're never going to find AT&T in here versus maybe 4 or 5 times a year when there's big news out there about AT&T. Other than that, you're never going to see AT&T on this list. Now, another way that you can do it, if we come back to the chart, you can see here that I have a community list. These are stocks that I have decided that the community is looking at that are great picks right now. Duolingo, Estee Lauder, Disney, AppLovin, and what is this? Robinhood. These are stocks that we're waiting for. Now, with that being said, the community is a great place to be. When I first started trading, it was a very, very lonely road. It was me, myself, and I had to figure it out. Now we have YouTube. We have communities that exist out there. We have people in our community, in our Patreon chat, that talk about stocks all day long. They send these stocks to each other. Now, if I'm looking at my list over here, many of these, SkyWest is from a community member. Disney, that was from a community member. Abercrombie, from a community member. Lululemon, from a community member. There's conversations that are actually Duolingo, from a community member. There is constantly conversations that are going on. This is a great way for you to pick stocks because they can be vetted. Just like you're using Yahoo Finance to vet something, you can be vetted by members of the community. Join it, give it a shot. It's a great place to be. And you can ask any of these questions that you're getting from this video. You can ask those questions in the community. Likely somebody will give you an answer. And of course, I'm there too. So let's talk about some patterns here. So we have a couple of patterns. One I'm going to go through is called an ugly face pattern. This is a pattern that you're going to see frequently. And it's easy to identify when you get the reps in. If you're looking at this right now, you're probably not seeing what I'm seeing. But I implore you again, go through many stocks, zoom out, try to find these patterns. This right here is an ugly face pattern. You can see it kind of looks like a face when I draw it in there, right? And what happens when an ugly face pattern occurs? Stock price falls down. Now, can you see this before it happens? Yes, you can see that an ugly face pattern is developing. So let's talk about how it happens. So I'm going to pull this out and turn this black. So let's get rid of these candles here. So we can see that a pattern is developing. So we're going to go and say, all right, left side of the pattern is developing. It's coming down. Now, if it gets down here and we start creeping up, stock price starts creeping up, I'm saying, okay, we have an ugly face pattern developing, and let's get rid of it now. And let's see, we're looking to say, is this stock price going to stop on the right side? Let's draw on the left. Is this going to stop right here? And if this stops right here, if it hits that high, that dotted line that I just drew, what is it going to do? It's going to fall down. Why? Because it's facing a level of resistance that it can't get through. Anytime you see a pattern like this developing, the stock price is going to fall down. You can see it so many different times if you just start zooming your charts out and looking for them. Over and over again, even here. We're just zooming this out. You might be saying, well, you're playing Monday morning quarterback right now. You can see these happening in real time. If you watch any videos, you've seen that I've called them over and over and over, and they are very, very easy to see. Very, very easy to see. See that? It just keeps falling. Now you also have head and shoulders patterns. What's a head and shoulders? Well, a head and shoulders is this one right here. You can see these happening too. Stock price moves up. It pulls back a little bit. It skyrockets up. It falls back down. It moves up again. And then what happens? Boom. Why? Head, shoulder, shoulder. Boom. That's what happens every time. Look at this one. Up, down, up, then what? Boom. Head, shoulder, shoulder. And you can see these happening in real time. I know you're looking at this saying it's easy to see when you go back months and months and months. Yeah, it is. But it's not hard to see. We're actually developing a head and shoulders right here. Here's your head. Here's your shoulder. I would actually encourage you to come back to this one and see, do we get something like this on Palantir? On Duolingo. I would encourage you to come and see if you get something like this where it falls straight down, because we are developing a head and shoulders pattern right here. If you can notice head and shoulders patterns and ugly face patterns, you are going to be a very, very good trader. Let's talk about 50% rule. Let's go to CCL. This is a stock that I'm currently in. 50% rule is very interesting because it's not typically seen throughout the market right now, but when it is, I can go in and just say, I'm going to go short on this. So if I do 3 lines in here. Here's your 52 or all-time high, whatever. This is your big high. And here's your low. And you can see here, I'm running this back to 2020, guys. This is 2020 right here. 2020. I'm going to tell you a little story here. I bought this thing in here. This was, I don't know, $6, $8, $9. It doesn't matter. And why does a 50% rule develop? Well, let's explain it first. Stock price falls big time, right? Then you have it rallies back up and it falls back down. And it just keeps rallying. It can't break through this level. And why is there so much black right here? It's because the stock price can't get there. It's negative pressure pushing down on the stock. 50% rules. What does it take to get through a 50% rule and fill this area out? So what is it going to take to get up in here? Volume. Goes back to volume. Everything basically goes back to volume. Now, look at this. Bought in here, $6, $7, $8, $9 a share, whatever. Stock price comes up and then it falls back down. Why does it fall down? Because these people here are saying, if I could just get half my money back, I bought it at 50. If I can just get it out at 25, 30 bucks, I'll be happy. They start exiting. What happens? Stock price falls back down. Again, runs up. If I can just get half my money back, these people didn't sell here. Falls back down, up, falls down, up, This is what happens with 50%. So I actually bought this thing in here. I didn't exit here. I didn't exit here. I didn't exit here. I exited somewhere right in here. I remember I was hiking in the woods and I saw that it got to like 30 bucks a share. And I said, this is never going to break through this 50% rule. I'm going to exit. And I exited and it has never touched it since. It's creeping on it right now. But if we look, this is why I'm short on this right now. If we look, the average volume, you can see the trajectory of the line. You're here, and where is that line going? Lower, 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 lower. So you have you can see the slant to it. You have less volume now than you did back in 2022, 2023. That is why I am short on this. It's going to fail, and this is why 50% rules are so powerful. If you come back here and you look at Boeing, this is another notorious 50%er. Boeing was at 400 bucks a share. Yep, 400 bucks a share right before COVID, fell down to about $100 a share, and it cannot get through 230. 230 is the level that it cannot break through. It's broke through a couple of times, but it cannot break through and stay there. Okay, now staying on CCL, I want to talk about something that are called tracker shares. When you watch videos of me, you might say, oh, I like a tracker share on this. What exactly is a tracker share? Well, it's when you go in and buy or sell short one single share. And you may say, well, why would you do that? If I let's say I short CCL. Let's say I short CCL at $28.48. And let's say the company goes to zero. I make $28.48. Why is that beneficial? Well, it's beneficial because, look, when you have a watch list over here, look at all of these stocks over here. And this is a short watch list compared to other people that I've seen. I think let's see what I have on here. 1, 2, 3, 4, 5, 6, maybe 12, 15, 14 stocks. I see people that have 50 on here. How are you supposed to find Lulu in here and separate it from the rest? You could very easily miss that, even if you move it to the top of your watch list. But if you have one single share in your brokerage account, you are going to pay attention to that because you shouldn't have that many stocks in your brokerage account. The idea is, let's look at CCL. It moved through the sweet spot nicely, okay? It went sideways, it's about to break down, and it's about to turn into a short coming through the sweet spot. Remember, 80% on the top, 32% on the bottom. This is the area we have the highest probability to make money. So we're waiting for these two lines to get into the sweet spot. Now, instead of us just waiting and checking back every day and hopefully checking back every day, why don't we sell short one single share? Then it's going to be in our brokerage account. I'm guarantee that you're going to pay more attention to it and say, oh, look, CCL is in my brokerage account. It's in my Schwab account. It's in my Robinhood account. I'm going to go check it. And as it starts to creep down here into the sweet spot, you're going to be the first one to remember, oh, let's short it right below this 28, 27 number, whatever it is. Look for that engulfing candlestick. It incentivizes you to look every single day at the stock versus losing it in a watch list. Now, with that being said, do not go and put tracker shares on everything. You should not have thousands of dollars on tracker shares. You should have a tracker share on truly something that you, one, want to pay close attention to, or two, is getting so close that it's days away. Like CCL for me right now is days away. This line that I drew right here, I am waiting for it to break that line. That line is about $28 a share. So once this thing gets below this yellow line that I drew, red and yellow will be in the sweet spot coming down, and I'm going to wait for that engulfing candlestick. And because it's in my brokerage account that I'm checking every day, I'm going to be the first one to grab it, and I'm going to have a really nice entry point. Now let's look at and talk about what this stock is actually doing up here. Actually, let's go to a different example. So let's go to something like NVIDIA. NVIDIA, if you look at the long-term chart, you came through the sweet spot in May, June, so earlier in the summer, and you got to the top, and now what's happening? It's just going sideways. And what happens when stocks when they come through the sweet spot, what's happening? Well, the stock price is moving up. What happens when they go sideways and they're in this overbought area? Does that mean sell? No. That means wait. Just see what it's going to do. When our stochastic turns down and goes into the sweet spot the other way, that's when we sell. So if we're just going sideways, that's great. What happens when stochastics go sideways? Prices continue to climb. This right now is called a power stock. Why do we call it power? Well, it's making what are now all-time highs. You can even say 52-week highs, but all-time highs. And more importantly, it's over all four major moving averages. So you're over the 200-day moving average, you're over the 100, you're over the 25, and you're over the 50. Why is that good? It eliminates those resistance levels that you need to break through. Could there still be resistance levels? Yeah. Basically, volume is a resistance at this point. You need to sustain great volume to continue climbing like this. It's looking like it's running out of steam right now because we're a little bit below average the last 2 days. But a power stock is being over all four major moving averages, making new 52-week highs or all-time highs, and you need volume to continue that push. So remember, this is the key thing to remember. I don't advise buying stocks up in here. You want to catch them through the sweet spot and let them run. You don't want to buy somewhere in here just because it's making new all-time highs. Now, could you buy? Yeah, you could. You certainly could. I don't advise it, but you want to catch the run through the sweet spot and the continued climb. And when stocks get overbought, that's a good thing. Let them run. Let them run for months and months and months. If you go back at some examples in the past, Google and Costco are two. They were 9 months where those things just ran. Stock price just kept climbing. It was a power stock. Now, on the other side of things, you have what's called a dog stock. Now, a dog stock, let's look at Abercrombie. This is a stock where you have something that comes through the sweet spot, right? And then it gets to the bottom, and what happens? It goes sideways on the bottom. And what happens when stocks go sideways on the bottom? They continue to go down in price. Just like on the top, they continue to go up, these continue to go down. Now, these are perfect for putting tracker shares on. Why? Because when a stock is on the bottom, it's very beaten down. You can put one share on it and say, okay, let's say you put it in at $60 to go long. You're just waiting. And when it starts to creep here towards the sweet spot, I actually did this. I had a tracker share on somewhere in here, started to creep towards the sweet spot, ended up making a nice trade on it, ended up exiting, I don't know, somewhere in here. This is a massive resistance point right here that we can see. But it worked. You put a tracker share on a dog stock, and you just wait, and you're the first one because this is so out of favor. Institutions aren't paying attention to this. This thing has been losing for such a long period of time. Nobody wants this thing. But ever so slightly, it's just going to start getting better and better and better. And once you break into this sweet spot area, people are going to start taking notice. Why? Because the stock price is continuing to climb, and that's what the majority of people chase, especially institutions. They chase stock prices going up. Why? For their clients. JP Morgan clients cannot be in Abercrombie & Fitch, while Morgan Stanley clients are not in Abercrombie & Fitch, while Charles Schwab clients, while Bank of America clients, these people have career risk. These institutions need to be in the stock. So if you have Amazon stock going up, everybody's going to go to Amazon. If you have Amazon stock falling down 30%, everybody's going to get the hell out of Amazon. That's just how it is. They have career risk. They have to be in what everybody else is in. That's why I don't like financial managers. It just doesn't make sense. All they do is chase stock price. So let's take advantage of that. When you have a stock creeping towards a sweet spot and it starts to break in, stock price is starting to climb, you're going to have people that are start nibbling at Abercrombie and Fitch. It's retail. It's starting to move. Great. Let's start doing it. Abercrombie is still a pretty good name. And you can run this through the sweet spot. You'll be exiting, well, we exited before earnings, somewhere right in here. That's the idea behind the dog stock. It's so beaten down, but you can be the first one into it as it starts to make that climb. Now, kind of on the topic of price action, let's talk about some price action. So let's go. We're kind of going to go back to candles right here. And this is a nice example. I see a lot of people that will panic when they start losing money or losing profits. So and this is natural. This goes back to the beginning of the video where you need to control your emotions. So we're in the sweet spot here, right? We're in the stock. We're moving to the top. Everything is looking really, really, actually, you know what? Let's go to NVIDIA because it's just going to be a little bit better description because it's still in the sweet spot on the top. We enter here. We enter somewhere in here. We start making money. Great. We get over here. Now, there were times in this run where, yeah, you were making money. And then look, this thing got to about, let me see what we were at. We were at $135 a share, and it pulled back to $128.85, $128.50. I bet there's a lot of people that panicked in here and said, okay, the run's over. Well, I'm going to exit this thing. Why would you exit that? You are beautifully running through the sweet spot. Remember, if you trust your trend, if you believe that the trend is your friend, you're going to do very well. Because look what happened in subsequent days. Again, ran up. Even in here, pulled back a little bit, and you're probably saying, man, I've made so much money in here. This is really great, but it looks like it's starting to fall back down. Well, let's look at the trend. Doesn't look like it's falling to me. The problem is, what I'm trying to drive home right here, is when you get snapbacks, when you get prices that fall down like this. Even in here, this is a perfect example. Look at this, guys. It ran up. You got a big pullback here, ran back up. Big pullback here, ran back up. Big pullback here, ran back up. Big pullback here. Now you're at all-time highs. What if you would have exited somewhere in here? You'd be pretty pissed, right? Well, the trend never told you to exit. The trend is still perfectly in your favor, actually. Why would you be exiting a stock? That's the problem that I see most quote-unquote traders going for. They chase price action, price movement. That's not what you chase. You chase trend. You follow trend. You do not get out on what are called snapbacks. You need prices to fall back down. Remember when we talked about W formations? Look, guys, what are W's when you really think about them? Look, when you're creating these support levels in here, right? What are you doing? What are those support levels? It's the stock price goes up and pulls back, goes up and pulls back. I need stocks to have down days. If you have a day, let's talk about a flagpole pattern right here. If you have a day where a stock price just goes straight up, what's going to happen? It's going to come straight down. Here we go. If we look at something like this, this was probably 7-8 days. Stock price ran straight up. What do you notice? There's no W formations in there. Between here and here, it just went straight up. And then what happened? It came right back down. W formations come right back down. And they come back down quick because there's no support in there. I'm sorry, flagpole patterns go straight up. And when they come down fast. You need to have pullbacks. You need to lose money for a certain amount of days while you're creating those W formations. So when you get pullbacks, embrace them. Make sure they're not going below the left side of your W, but embrace them and say, this is great. This is creating a support level for me. This is exactly what I need. If I'm in a stock, and let's say it goes from $10 to $20 a share, so that's a massive gain, right? I'm more likely than not going to exit that thing at 20. Versus if it goes from 10 to 20 while going from 10 to 11, pullback, 10 to 12, pullback, 12 to 13, pullback. Because it's creating those support levels, you need to accept that you're going to have to see pullbacks. It just is. If you see flagpole patterns, which are stocks that just go straight up, they're more likely than not going to come straight back down. Okay, now a common thing that I hear is, Mo, every time I trade a stock, that stock price pulls right back down. Why does that happen to me? Well, I just clicked on Duolingo. I was just going to run through my watch list. Look at this. See this number right here? $2.44. That is massive. That means that there's manipulation going on in here. This is the bid-ask spread. Remember, this is a market. This is what somebody wants to buy it for. This is what somebody wants to sell it for. So when you see, and you're going in there and you see a big spread between the two, this should be a very small number. In this instance, because this is a $300 stock, 20 cents probably max. If you have somebody in a market that wants to sell something for $100 and you only want to pay, I don't know, 50, there's a massive spread between the two. There's a big discrepancy. Now, if you go and buy said item for that $100, the next person is what is he going to do? He's going to go, well, I'm going to raise the price on you, or I'm going to lower the price on you, just depending on what the next person is willing to pay. That's where this whole thing comes down to. There is a bid and an ask. So let's talk about this instance right here. You go in and you buy this for, let's just call it $306 on the nose, okay? 306. Well, they want to sell this for $347, right? And you're going to be the sucker in the room that's going to go overpay for it. And what is this guy going to do? What is a market maker going to do as soon as you go and pay $306? He's going to drop that price down. He's going to drop this price down even lower. And then what's going to happen? Well, let's say it goes to $304 and you go, well, how come I lost? How come I lost? Because he just dropped this to $301. And now that move makes you look like the sucker in the room. So you need to, the moral of this story, you need to pay attention to the bid-ask spread. So if we're going to go look at a stock like CCL, this is a $28 stock, $29 stock. You want to see a 1 cent spread. It's never going to be zero. You want to see 1 to 2 cents. Let's go start flipping through just to make sure. High manipulation going on right here. $100 stock. The difference between the bid and the ask is $101 or $1.32. It's $101 over here, $99.80 over here. This, for something like this, 5 cent difference. You need to have a 5 cent difference to have that continuity between the two. Let's continue on. 1 cent spread, that's great. No manipulation. Manipulation going on here on Generac. When are you going to typically see the manipulation happening? In the morning. That's why I said you wait until 10:06 in the morning to trade. You have a lot of, I wouldn't even say manipulation, it's just overnight trades settling, options trades settling, news overnight that's spiking, people going buying and selling in the first 30 minutes, algorithm trades that are settling overnight. That's why I don't like to trade in the first 30 minutes. That's when you're going to see the craziest bid-ask spreads going on. News days, big news days for stocks, you're going to see big bid-ask spreads. That's what this is all about. So do not be the sucker in the room that goes and overpays. Make sure you check your bid-ask spread. Somewhere between 1 and 2 cents on stocks that are under $100, maybe 5 cents at the absolute most. $300 stock, 20 cents, no more than that. It does matter. And if you don't believe me, go and trade something that's trading at $1 bid-ask spread and you're going to get smoked. Now, speaking of getting smoked, earnings. What are these E's here? These are earnings reports. Earnings are a total crapshoot. Let's see what we have with Disney here. So Disney reported its last earnings, August 6th. They beat on earnings per share by 10.7%. They missed on revenue by $43 million. Guys, we're talking about $23.65 billion in revenue. They missed by $43 million, and the stock price ended up falling 2.66%. The following day, it fell another 2%, then 0.5%, and then it settled off right around there. The point is, this is a total crapshoot. Let's go through and see if we can find some other crazy earnings reports. Earnings are a total crapshoot. Here was a big hit. Beat on top and bottom line, stock price jumped. Here was a beat on top and bottom line. You would think the stock price would soar on that day. It was down 4.5%. It's a total crapshoot. Therefore, I do not trade earnings. So when earnings are coming up, let's say that I was in Disney. November 5th, after hours is Disney's report. I believe they report after hours. Oh, no, they report in the morning. Okay, so November 4th, I'm going to exit this before the market closes. You cannot be it's a total crapshoot. Sometimes you're going to get lucky. Sometimes you're not. More often than not, you're not. You're going to see a big price jump in whatever direction you're probably not going in, and you're going to get smoked. Do not trade earnings. Do not trade earnings. I promise you, you will get smoked if you trade earnings. Worst case scenario, you're in a stock for earnings. You actually make money on it during the earnings report, and you think that's going to happen to you every time. It's not. Trust me, do not trade earnings. Now, exiting stocks. So if we're looking at something like Walt Disney right here, and we're looking at this from a swing trading perspective, well, I'm looking at this saying, okay, let's draw in support levels. This is something I like to do. I like to draw lines. This is a support level. Why did I just draw the line there? Well, the current price is there, but also you can see it was there a couple of weeks ago. It was there a couple of months ago. It had a lot of consolidation in this area, meaning that the stock price just bounced around this line that I just drew. Let's continue back further and look at that. You can see, and guys, I'm just going to keep, you know what? Let's do this. Let's get rid of this and let's show you. So where the current price is. We can take this all the way back in here, consolidation. You can see it leveled off there. This is back in 2024. You can see how many times we hit this line. Let's go back to 2023. Let's go back to 2022. Let's go back to 2022 in here. We can probably go back even further, even throughout here, right in here. This is where you hit a bottom in 2020 in June, July. It's a very, very strong level. So if I'm trading this, I am saying if I'm short in this, let's say that I'm short right now. I'm shorting this to bounce off the 50-day moving average, and I'm letting it run down. I am taking profits right here, if not exiting. I could take profits, meaning that I just take my profits off the table. So if I have $100 in a stock, it goes up 10%. So that means I have $110 in the stock. I will take $10 off the table and just leave my cost basis in there. So looking at this, you could say, all right, I'll just take my cost basis off. I'll take my profits off, leave my cost basis. Maybe it can get down to the 200-day moving average. Maybe it won't. But at least I have profits in my pocket. Or I would just exit this because of the line that I just showed you that goes all the way back to 2020. That is how you take profits. You take profits at resistance points, support levels. You would be taking profits up here at the 50-day moving average. You can see how many times it hit the 50, fell back down, hit the 50, fell back down, hit the 50, fell back down. That's somewhere you would take profits. Down here, you can see, hit this level, next day, up, hit this level, up, hit this level, hit this level. You can see that this level, same level, is a very strong level of support. That is where you take profits on stocks. Now, so this is, if you just finished this video for your first time, go watch it again. Go watch this thing 2 or 3 times. If this is your second or third time going through this and you are ready to go see another example and put what we just practiced to preach, go and check out this example here, take the next step, and I'll see you on the next video.